Welcome to the webinar. You have entered as an organizer and may now speak to any other organizers or panelists on the line. When you are ready to begin the presentation, press the Start Broadcast button on the GoToWebinar control panel to allow all attendees to hear you. This system will notify you once you begin your broadcast. The broadcast is now starting. All attendees are in listen-only mode.
Good morning. I hope you guys doing well and welcome to today's edition of the London Session Open. Today is March 5th, 2019, and you should be able to see my screen right now. We should be looking at the ATFX homepage. Starting with a bit of a delay today, having some technical issues. I was actually kicked out of my own webinar. Asked to sign in after that. We're going to take a look at the markets as we usually do. But before we do that, as always, I need to show you guys the risk disclaimer. I know most of you guys have some vast trading experience. We have some familiar faces here like Marvin, Nikos, Rich Bell, Taufik, Vincenzo, Keith Jones, Ivan. So a lot of you guys have experience, I know that, but not everybody is gonna watch this live, then maybe gonna watch this on YouTube. So we need to make them fully aware of the risks involved. Okay, so we're gonna take a look at the markets. I'm gonna share with you guys my view on the market and what I think is happening. But this is obviously done in a public forum, and it's not made as the trading advice. In fact, it's made as an educational with an educational purpose, in the interest of making everybody that's watching hopefully a better trader. Now let's kick off and let's spend a few seconds on the risk disclaimer, and then we're going to begin and take a look at the charts. Okay, let's begin. All right, so Euro, there's not much happening here right now. This actually been probably one of the easiest things to analyze over the last few months. It's just trading sideways. A lot of people have tried it to trade this range, and of course it's possible to trade the range. You buy at the lows, you sell at the highs, but it doesn't happen that often that we actually visit these extreme levels, and the market is just moving extremely slowly. So it's not very interesting for me as a trend follower to trade this. And I remain on the sideline, and I'm just waiting for a break to 112.12, alternatively a break to 115.67, which happens to be the January 9th high. GBP versus the USD is moving upwards, which is great. As you might remember, on the daily chart, you have head and shoulders with a left, right shoulder, and this is the neckline. I know we're actually deeply into the actual pattern again, which should sort of cancel this whole setup. But when we first had that breakout, I sort of suspected that we needed some sort of a pullback to 132. The market, though, it had the breakout and then immediately went upwards. So I think everybody got a little bit too excited, and then the market went up. And then as we moved down, all these sort of late to the bull party decided to exit, and that caused that market to move down, and then have actually further move lower yesterday. Now, what's important here though is that we don't trade much lower than 131.40. If we do, we're definitely not dealing with an uptrend here. It maybe have morphed into something different at that time, and I don't want to be bullish anymore. As always, we're dealing with risk reward ratios, and we're not dealing with sort of guarantees in this. If you need a guaranteed paycheck, then a normal job, a 9 to 5 job, is what you're looking for. Um, Financial markets don't work like that. Now the idea was buy here at pretty much 132-ish, stop loss just below. So we're risking 60 pip. If we just go back to the high, then that will be 2 times the risk. If we actually travel all the way towards that risk reward ratio, or that the target of that inverse head and shoulders pattern, then you're looking at 13.22 times the risk. That's obviously a very, very good risk reward ratio. And the reason why it's so good right now is just because we're so close to the actual stop level, right? So it's a little bit of inverse, not an inverse correlation, but the risk reward ratio will usually be, not usually be, most of the time be 1 to 1, maybe 1 to 1.5. And then when you have that very good entry, like here, for example, if you would have traded that breakout from the beginning, then you have something like this. If you would have just traded the breakout when it happened, then your risk reward ratio had been 6.14. But then sometimes that it happens like this, which the market sort of just goes very close to your stop loss, and that's why we have that very, very good risk reward ratio. But the only reason why we have that very, very good risk reward ratio is just because we're almost getting, this trade idea is almost getting stopped out. So that's an issue there, and you need to bear this in mind. If you're looking for too much of a risk reward ratio, then it's usually happening and you're giving that opportunity because of the wrong reasons. Now, this is the dollar versus the Japanese yen. So this is actually a very good example. So we talked about this, about buying on the breakout here with a stop down here. So we hit that first target for a 1 to 36 times risk reward ratio. And then we moved back to these levels. And at that point, I had actually reduced my stop loss quite significantly. So I'm just going to put it up here. So the idea was to go long pretty much here somewhere, like here, which we did. And then the stop loss was somewhere here, if I remember correctly. And then the market was supposed to go upwards. That was a 2.66 times risk reward ratio. But again, so the reason why we got this very good risk reward ratio is just because the market almost got us stopped out. And then here again, it went back. We had another idea, pretty much looked to buy. I said, look to buy here somewhere. And the stop loss was the same as before. And again, we got a 4.91 times risk reward ratio if you would have booked profits today. And again, it's almost because we just got stopped out. On the onset, most of the time, we're dealing with a more balanced risk reward ratio. Here, as I said yesterday, I think if people buy from 111, 26 or 22 actually, it says here, and then we just reach those high again, then you're looking at a less than a 1 to 1 risk reward ratio. But of course, because we're dealing with an uptrend, the idea is that it goes down and up to the high, and then maybe adds a little bit more, and then suddenly you get a 1.57, and you might even get more. Now, this market is a bullish market today. Okay, it may actually just continue to trade upwards without having that correction. But why would I not buy? Well, because at its best, it's gonna go all the way up to the high. Okay, and it should, as a minimum, move down here, but that's not a good spot to put a stop loss. Stop loss would need to most likely be down here at 110.34. So from this perspective, you're looking at a 1 to 1 risk reward ratio, which is okay, but it's not ideal. So the better is wait for that pullback to 111.22. Stop loss just goes below. If we hit that target up here, you're gonna get a 2.81, and if it just revisits the high, you're gonna get a 1 to 1. You see, that's sort of what's going on in my mind. I'm always looking at those risk reward ratios when I'm taking a position, and I want to do that with the trend. I know that if I just stick to decent risk reward ratios, so minimum when it's short term like this, a 1 to 1, maybe 1.5 is usually sufficient. Now, I don't know Nobody knows because we're dealing with random markets most of the time. So no one really knows exactly, if the next 100 trades are going to be profitable or the next 100 is going to be losing. We only know that there's going to be some sort of combination of winning and losing trades. And what's interesting here is that if we just stick with the trend and you stick with the risk reward ratios, then things will resolve by itself. The problem though is that it's hard. It's mentally difficult to keep positions when they almost get you stopped out. Keep the positions when we haven't reached targets. But if we just do it, then it does work out. Okay, this is the price of gold. And here we're dealing with that uptrend. The market took out support, and the market, I think, it can continue to tumble. But it's much like what I just said. The closest low here is pretty much here. So if we short today, you might make another 0.5% to $7. But the market could easily go up to 1,301. Might even push deeper into this zone here. So I would prefer to wait for that pullback and then wait for that decline. Doing like this, we get 0.91. The way to figure out where to short sell, like why did I pick this level? Well, firstly, is a bunch of lows here. Support most likely turn into resistance. So that's sort of a first thing. And then you just take a Fibonacci like that, gives you all these 3 fibs. You can see that my stop loss level is beyond the 3rd fib, just above this high. So the market really needs to rally strongly to get me stopped out. It needs to trade more than to the 61.8% correction level. And again, sort of here somewhere, I think it makes sense to turn bearish. Now, I don't know exactly if we're gonna stop here, here, or here, and that's why I have this whole area. Sometimes the market just goes close to the sell zone, just grazes it, and then just goes down. Sometimes it goes deeper and then goes to the upside. This is much more straightforward. This is crude oil. We're still dealing with an uptrend. You have a low here, low here, low here, and then you have another low here, which is the February 26th low. And as long as you trade above that level, I think it makes sense to continue to remain bullish because we're dealing with that uptrend. Not only that, if you take a step back, you might remember that we're dealing with this massive head and shoulders. And this head and shoulders itself is suggesting a $10 move, 10.69, which gives us a target of these levels here. So we're still dealing with that. And here in the short term, you have a double, triple top, a nice little rectangle. Difference between high and low is $2.9. So on a break to 57.89, I think we can go upwards. At the same time, you have all these people being long on that breakout, and they probably have their stop loss orders down here. And if we trade below the trend defining level, I think we can trade a little bit lower, maybe to something like 51.88. S&P, unfortunately, just messed up with a lot of people yesterday. It's like that sometimes. What I do is I lift the stop loss order, so the trend defining levels, put them closer and closer, and then eventually put them so close that it's sort of inevitable that I'm going to be stopped out. Now, unfortunately, what happened yesterday is that the market went all the way up, all excited about the trade deal with US and China, and then a big tumble as the futures market opened. I think it definitely sort of flushed out some people that were long here. I was not trading this directly. I'm not holding this market, but I'm holding another stock market. Anyway, it went down, and that appeared to be sort of a false move. We're now sort of within this rectangle, this range, and we've been trading here since the 18th of February, really. So right now, I'm neutral here. I think that a break to 28.21, which is level up here, could probably lift the price to 28.91, and a break to the downside here could probably take you lower. And that's pretty much it. So the trend remains bullish, but probably that break is needed. Alternatively, this move here. German DAX continues to trade strongly. As you might remember, we had several setups here, but the last one I said is that head and shoulders pattern. So that head and shoulders pattern is still working out. It's definitely taking its time, but we're still dealing with an uptrend. The price reached this level, and you have yourself right shoulder, left shoulder, break here should lift price all the way up here, and it's relatively straightforward. I think here, as long as you're above 11,392, that we're going to be bullish. And yesterday I said if we have a bit of a corrective move, I think people will buy. Now, what happened here though is that we didn't actually touch that little buy zone. We did correct 50%, but I had my entry level slightly below it. If you're not involved, there's not too much to do. And who knows, maybe the US opens and the market crashes again. So I remain bullish, but if one is not already long, it's very important to take a step back and sort of wait for that little pullback. We have some near-term resistance, which is this high, followed by this level up here. But I think if we clear 11,686, we're probably going to trade upwards. And what's happening with stock markets in general, guys, is that a lot of people have been getting it wrong. Even myself. I had some, in October, the market crashed down, okay, stock markets. And then we had a little bit of sideways price action, and then the market continued. And I'm talking about the S&P here. I was bearish here in this section here, and that worked out relatively good. I traded the Canadian stock market of all markets. Didn't trade this directly. And obviously, when you move down, you said, okay, most likely we're going to have some negative indicators, or bad indicators like the ISM and so on and so on. The ISM indicators definitely moved down. But what happened here is that the stock markets moved ahead of the economic indicators. And now we had that bounce. So you had the market PMI composite, which is a survey indicator for the US, that one bounced. You have the China Caixin PMI index, well, that bounced as well. It's not above the 50 level, which indicates expansion. But what's interesting here is that the stock market has led the economic indicators on the move to the downside, and also has been leading some of these indicators on the way upwards. And now as well, what's happening is that we could have a deal between US and China, and that could result into the removal of all the different tariffs. So suddenly you're getting a bit of a boost in risk sentiment, and you're getting a boost in the probability of both the US and China picking up some steam, their economic activity. So suddenly this whole bleak, gloomy outlook is not really there, because the market in this case actually led the indicators. And it's usually, well, I wouldn't call it usually, but sometimes it is like that. Most of the time, actually, what happens is that the stock market declines and have a big bearish decline, and then it proves to be a false move. That has happened many times, where the stock market declines strongly. Everybody sort of settled for a recession, and then it doesn't really happen. There's like a saying that the stock market has predicted, I don't remember exact numbers, but say the last, it has predicted, it's giving 9 signals, so say 10 signals of a recession, but we only had recessions maybe 4 or 5 times. Now, obviously, what's a little bit different here compared with before is that this market bottomed out in 2009. So everybody is on the lookout for that next major decline, because people are looking at statistics and say, oh, it's been many years now, this has to happen. Of course, the more time it goes, more likely we're going to have something, I would say. But the problem here is that these markets, they don't follow any specific cycles. If you look back at recessions from the 1950s or 40s, whenever we have data from, there's not like a specific, like every cycle is different. Anyway, so what does this mean? It means that if it's correct that the stock market indeed is sort of just leading all the economic indicators, then what if the indicators continue to become better? Then we can probably have that little push to the upside. And if the economy in general sort of improves, if we get that deal in China, then we can probably when we have that pullback, if we have it's just a normal technical correction, not related to what's going on in the underlying economy, then I think we go down and I think people are going to buy again. That's what I think is going to happen. So that's sort of what I'm doing. I'm holding a stock market long position myself. It's the only position I'm holding. I don't really see anything that is super interesting right now. Okay, let's see if you guys have any questions. Just put them in the chat box and I'll see if I can help you. So we have Nikos here. Good morning to you, sir. I hope you're doing well. If you have any questions, just put them in the chat box. As well, if you guys are new to ATFX, do check out their homepage. ATFX is FCA regulated broker. We have a relatively big office here, about 20 people or so in the London office. The main headquarters is actually in Hong Kong. They have a big operation in mainland China and in that region, and they're looking now to expand new business in Europe. Now, what's really interesting with these guys, and I showed you these guys before as well, that we have very tight spreads. So they are two different sort of accounts: retail standard account, and then you have retail edge. Now, retail edge, it's sort of their slightly more premium trading account. However, it's not that difficult to qualify for that. To have the edge account with, say, FXCM, you need to have $25,000 dollars or pounds with them. Here is enough to have $5,000, 5,000 euros, or 5,000 pounds. And you qualify for these very tight spreads. These are some of the spreads you see euro dollar. This is the minimum spread. So euro dollar pretty much 0.7. Just add one to most of these. So all the majors are really tight. But what makes this company different to many other companies, like the big ones, is that the Forex miners like Aussie CAD, Aussie Swissy, Aussie dollar yen, they all have really tight spreads. Look at that, Aussie dollar yen, 0.9. That's nothing. A lot of the other brokers, what they do is that they're going to give you very tight on the majors. And then what they're going to do is that here they're going to put, 1.5, 2, because you don't trade these too often. And at the end, what happens though, that you still trade them, so you still pay. So you can do some significant savings, I would say, by switching over to ATFX. And what we're doing right now as well is that for anyone that opens up an Edge account with ATFX, you also get access to 2 30-minute coaching sessions with me. What happens is that we'll use the same sort of setup like the one we're looking at right now. So I can see your screen, you can see my screen. We'll spend the first half hour to sort of answer any questions you may have, and as well I'm trying to understand what you want to accomplish with your trading. So I'll ask you questions and to try to understand you better. And then if you don't have any strategy at that time, I'll be just asking questions, answering your questions, and I will be asking you questions. And then what I do is that I go away, sort of try to figure out what could be a good route for you. And I'll send you a few educational links sort of to help you build some sort of a strategy. And a strategy needs to have a well-defined rule for when to enter, a well-defined rule for when to take a stop loss, a well-defined rule for when to take profits, and a well-defined rule to know how much to risk per trade. So that's something as well that you get with the Edge account. So check this out, compare the spreads. I'm quite confident that you'll see that our spreads are really very competitive. And then as well, you have these coaching sessions. Okay, I think we're gonna wrap things up. Guys, thanks so much for watching. I don't have any questions. If you have any questions to me, you can reach out to me via Twitter, as well at alejandro.zambrano@atfx.com. If you ever miss any of these videos, then you just need to visit our YouTube channel. I suggest you subscribe to it. What I usually do is as soon as I finish here, I upload the videos here, but it takes an hour or two because just the conversion takes about half an hour, then another half an hour, 40 minutes just to upload the file. Click here to subscribe. Okay, guys, have a good day, and I'll see you guys tomorrow, same time here at atfx.com. Thank you.